Have you ever wondered how to start investing? It's a question that puzzles many, but rest assured, it's not as intimidating as it seems. Today we're going to unravel the mysteries of investing, revealing how it can be your ticket to financial independence. Investing in its simplest form is about making your money work for you. Instead of letting your hard-earned cash sit idle in a savings account, investing allows you to grow it, expanding your wealth over time. It's a crucial tool for achieving financial goals, whether you're dreaming of a comfortable retirement, a dream house, or even a world trip. But investing isn't just about multiplying wealth. It's about securing your financial future, and more importantly, it's about freedom. The freedom to make choices, the freedom to take chances, and the freedom to live life on your own terms. So are you ready to take control of your financial destiny? Let's dive into the world of investing and understand how you can begin. Before we delve into the how, it's crucial to understand the why. So, why should one invest? Well, the answer is multifaceted. Firstly, investing is a powerful tool for wealth creation. By investing your money, you're putting it to work, allowing it to grow and multiply over time. This isn't just about having more money, it's about securing your financial future and gaining greater financial freedom. Secondly, investing helps you beat inflation. Inflation erodes the value of money over time, and by investing, you ensure that your money is not just sitting idle but is growing at a pace that outstrips inflation. Lastly, investing helps you achieve your financial goals. Whether you're saving for a house, planning for your child's education, or looking forward to a comfortable retirement, investing can help you reach those milestones faster. Investing, when done right, can open doors to numerous financial opportunities. Now that you know why to invest, let's explore the different types of investments available. Firstly, we have stocks. When you buy a company's stock, you're buying a piece of that company, becoming a part owner or a shareholder. The value of your stocks rises and falls with the company's fortunes. Stocks have the potential for high returns, but they also carry a higher risk compared to other investments. Next, let's talk about bonds. Think of bonds as loans you give to a government or a company. In return, they promise to pay you back the amount you lent them, plus interest, after a certain period. Bonds are generally considered safer than stocks, but the returns are usually lower. Then we have mutual funds. These are a collection of stocks, bonds, or other investments managed by professionals. When you invest in a mutual fund, you're buying a piece of this collection. They allow you to diversify your investments even if you don't have a lot of money to invest. Now, let's move on to real estate. Buying property and then renting it out or selling it for a profit is a common type of investment. Real estate can provide a steady income stream and potential tax benefits, but it also requires more hands-on management. We also have exchange-traded funds, or ETFs. Similar to mutual funds, ETFs are a collection of investments that track a specific market index. The difference is ETFs can be bought and sold like stocks during the trading day, offering more flexibility. And let's not forget about commodities. These include physical assets like gold, oil, or agricultural products. Investing in commodities can be a good way to hedge against inflation, but they can be volatile and may require more expertise to invest in successfully. Last but not least, there are options. Options give you the right, but not the obligation, to buy or sell an asset at a specific price within a specific period. They can offer high potential returns, but they're also high risk and require a good understanding of the market. Understanding these investment types is the first step towards building a diversified portfolio. Investing isn't without its risks, but it's all about balancing risk and return. Now, what does that mean? Risk refers to the possibility of losing some or all of your investment. It's the reason you might end up with less money than you started with. But don't let that scare you. It's a natural part of the investing world. On the other hand, return is the money you earn from your investment. It's the good stuff, the reason why we invest in the first place. The goal here is to maximize your returns while managing your risk. Now, here's the tricky part. Different investments come with different levels of risk and potential returns. It's like a seesaw. Generally, if an investment has a higher potential return, it also has a higher risk. Think of stocks. They can provide great returns, but they're also quite risky. On the flip side, investments with lower risks typically have lower returns. Bonds are a classic example. They're relatively stable, but the potential for high returns is lower. So, how do you find the sweet spot? Well, that depends on your risk tolerance. If you're a thrill seeker, you might be comfortable with higher risk investments. But if you're more of a play-it-safe type, then lower risk investments might be more your style. Balancing risk and return is a delicate dance, and it takes time and practice to get it right. But once you do, you'll be well on your way to making smart investment decisions. Remember, higher the risk, higher the potential returns. Armed with knowledge about why and where to invest, you're now ready to start investing. The first step to this exciting journey is setting clear financial goals. Are you saving for a down payment on a house, funding your child's university education, or building a nest egg for retirement? Knowing your financial goals will help you determine how much you need to invest and for how long. Next, it's essential to assess your risk tolerance. Investing always involves some level of risk, but the degree of risk varies with different types of investments. Generally, investments with higher potential returns come with higher risk. Understanding your risk tolerance will guide you in choosing the right investment products that align with your comfort level. Now let's talk about diversification. This is the practice of spreading your investments across various asset classes to minimize risk. Think of it as not putting all your eggs in one basket. Diversification can help balance your portfolio's performance, as gains from one investment can offset losses from another. Once you have established your financial goals, assessed your risk tolerance, and understood the concept of diversification, it's time to choose your investment platform. There's a wide range of options out there, from traditional brokerage firms to robo-advisors and online investment platforms. Each of these platforms has its own set of features, costs, and benefits, so do your research and choose the one that fits your needs best. Lastly, remember to regularly review your investment portfolio. The market is dynamic and changes often, so it's important to monitor your investments and adjust your strategy as needed. This doesn't mean you should panic every time the market dips, but rather, review your portfolio periodically to ensure it still aligns with your financial goals and risk tolerance. Starting to invest is a big step, but with careful planning and diligence, it can lead to rewarding results. Remember, the journey of 1,000 miles begins with a single step. The sooner you start investing, the sooner you can start growing your wealth. Here's to your financial success. As a beginner, investing may seem daunting, but here are some tips to guide you. Firstly, start small. You don't have to have a fortune to begin investing. Even a small amount can grow significantly over time. This approach not only limits your losses, but also allows you to learn the ropes without too much risk. Secondly, diversify your investments. Don't put all your eggs in one basket. Spread your investments across different asset classes, sectors, and geographical locations. This strategy can help to balance out the risks and maximize your potential returns. Thirdly, invest for the long term. Investing isn't about getting rich quick. It's about growing your wealth over a long period. So be patient and don't be swayed by short-term market fluctuations. Fourthly, do your research. Before investing in any company or asset, make sure you understand what you're investing in. This includes understanding the company's business model, its financial health, and potential risks. Fifthly, stay informed. Keep up to date with financial news and market trends. This can help you make informed decisions about when to buy or sell. Lastly, consider seeking professional advice. If you're unsure about anything, don't hesitate to seek advice from a financial advisor. They can provide you with personalized advice based on your financial goals and risk tolerance. Investing is a journey, and these tips will help you navigate the world of investing more confidently. Investing is an essential part of financial planning and wealth creation. As we've journeyed together through this topic, we've discovered the why and how of investing. We've delved into various types of investments, each with its own potential for risk and return. Remember, there's no one-size-fits-all strategy here. It's about finding what aligns with your financial goals and risk tolerance. We've also outlined the steps to get started. It's not as intimidating as it may seem. With a little research and a dash of courage, you're well on your way to becoming an investor. And let's not forget the tips we've shared for beginners. They'll serve as your compass in this financial adventure. So let's wrap this up with a gentle reminder. Investing is not a sprint, but a marathon. It's a journey of patience, learning, and discipline. Start your investing journey today and open the doors to financial independence.